Welcome back to Blue Collar Retirement. In this series, we talk about retirement in plain English, the stuff real working people actually deal with, not Wall Street buzzwords. Today, we're tackling something that confuses a lot of retirees: required minimum distributions, or RMDs. If you've saved in a 401k, IRA, or other retirement accounts, this topic will eventually affect you, whether you like it or not. So what is an RMD? A required minimum distribution is exactly what it sounds like. It's the minimum amount the IRS requires you take out of certain retirement accounts each year once you reach a certain age. You didn't have to pay taxes on that money while you were working in savings. RMDs apply to accounts like traditional IRAs, 401ks, 403bs, and most employer retirement plans. They do not apply to Roth IRAs while you're alive, regular bank accounts, brokerage accounts. Why do RMDs exist? The government allowed you to put money into those accounts tax deferred for decades. That was a great deal because you lowered your taxable income, your money grew without annual taxes, and compounding worked in your favor. But eventually, the IRS wants its share also. RMDs are basically the government saying you can't defer taxes forever. When do RMDs start? The rules have changed a few times, which adds to the confusion. Right now, for most people, RMDs begin at the age of 73. In the future, that age will increase to 75. Your very first RMD can be delayed until April 1st of the year after you turn the required age. But after that, every withdrawal must happen by December 31st each year. And that first year delay can create a trap. We'll talk about that in a minute. How is the RMD amount calculated? The IRS doesn't just pick a random number. Your RMD is based on one, the balance in your account on December 31st of the previous year, and two, a life expectancy factor from IRS tables. So as your account balance changes, your RMD changes too. Higher balance leads to a higher RMD, leads to higher taxable income. That's the key point. RMDs are taxable income. Let's do an example. You've finished the year and the balance of your IRA account is valued at $50,000 on December 31st. This year you are turning 73, and the RMDs will start and continue for the rest of your life. To determine the amount of your withdrawal, we need to look at a table from the IRS. It's a divisor number. For this example, we will use the IRS Uniform Lifetime Table. At age 73, that divisor is 26.5. Now let's do the math. We will take the $50,000 at year end and divide it by 26.5. The RMD this year is $1,887. The $1,887 needs to be withdrawn from your IRA before December 31st this year. The divisor number will go down every year. For example, when you are 80 years old, the divisor now is 20.2. So at 80, a $50,000 balance on the IRA would have an RMD of $2,475. Just remember, at age 120, you'll need to withdraw half of what is left in your IRA account. There are two other tables that can be used. Table 1 is a single life table used when an IRA is inherited by a non-spouse. Table 2 is used when a spouse is more than 10 years younger and the sole beneficiary. What happens if you don't take it out? This is where things get serious. If you miss an RMD or don't take enough money, the penalty can be steep. Currently, up to 25% of the amount you were supposed to withdraw. That's one of the harshest penalties in the tax code. So this isn't something you want to forget about. The real life impact of RMDs. RMDs don't just affect your retirement accounts. They can affect your whole financial picture. They can impact your tax bracket, taxes on Social Security, Medicare premiums, how much of your income is taxable, and even financial aid for your family members. Many retirees are surprised when their taxes jump after RMDs begin. Now let's go back to the first year trap. Remember how I said you can delay your first RMD until April 1st of the next year? Sounds nice, but there's a catch. If you delay, you'll have to take 2 RMDs in 1 calendar year. That can double your taxable income and push you into a higher tax bracket. Sometimes delaying makes sense. Sometimes it's a mistake. It depends on your situation. There are common mistakes that people make. Let's talk about a few real-world errors. First, assuming the account will handle it automatically. Not all plans calculate or send RMDs to you automatically. Second, forgetting about the old 401ks. Every account has its own RMD. Third, taking money from the wrong account. IRA RMDs can be combined with 401k RMDs. That's usually not the case. That can be a problem. Ignoring the tax withholding. You can owe a big bill in April if you don't plan ahead. Smart ways people handle RMDs? There isn't one right answer, but there are options. Now, some retirees use RMDs as a part of their income plan. Some will reinvest what they don't need and then plan withdrawals strategically over the years. Others look at Roth conversions before RMD age. Some charitable strategies, coordinating withdrawals with Social Security timing. The key is being intentional instead of reactive. So what about Roth accounts? This is why you hear so much about Roth IRAs. Roth IRAs do not have RMDs for the original owner. The money comes out tax-free and can be providing flexibility later in retirement. That doesn't mean everyone should convert, but it explains why Roth planning is such a big topic. RMDs and inherited accounts. So if you inherit a retirement account, the rules are different. Most non-spouse beneficiaries now must empty the entire account within 10 years and follow specific distribution rules. This catches a lot of families off guard and ties directly into estate planning, which we talked about in the last episode. The big picture, RMDs aren't just a tax roll, they're part of your overall retirement income puzzle. They affect how long your savings last, how much tax you pay, what you leave behind, and how comfortable retirement feels year to year. Ignoring them doesn't make them go away. It usually just makes them more expensive later. Final thoughts. If there's one takeaway today, it's this. RMDs are predictable, and anything predictable can be planned for. You work too hard to build those retirement accounts to let taxes and rules catch you by surprise. Thanks for watching this episode of Blue Collar Retirement. Next time, we'll break down another topic that everyday retirees are asking about in plain, honest language.